Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of a complete guide to discounted cash flow (DCF) analysis for business valuation. Applying the discount rate. Future cash flows aren't as valuable as money today due to risks and opportunity costs. To account for this, you apply a discount rate. Think of it as the price of time. Choose an appropriate discount rate. Most analysts use the weighted average cost of capital (WACC). This reflects the company's cost of equity and debt capital. Understand the risk factor. For high-risk companies or startups, you may use a higher rate. This reflects the increased uncertainty in realizing future cash flows. Discount each future cash flow. Use this formula for each year. Discounted cash flow equals FCF divided by 1 plus discount rate, year. For every year in your forecast, divide the projected cash flow by the discount factor. The farther into the future you go, the more the cash flow loses value. Once done, you'll have the present value for every individual cash flow. Summarizing results. After discounting all projected cash flows, it's time to wrap up the results and draw conclusions. This step pulls together everything you've calculated to arrive at the final valuation. Add up the discounted cash flows. Sum all the present values of projected cash flows. Include terminal value. Calculate the terminal value, using the perpetuity growth or exit multiple method, and discount it back to present value as well. Combine the totals. Add the present value of the projected cash flows and terminal value. This gives the business's intrinsic value. Once you have this number, compare it to the company's current market value. Is it undervalued or overvalued? This comparison is the crux of investment decision-making. If the intrinsic value is higher, the business might be a worthwhile investment. If lower, tread cautiously. Your summarized results provide a clear picture. How much is this company really worth today? With this, you've completed your DCF analysis, a powerful tool in financial decision-making. Common mistakes in DCF analysis. Discounted cash flow (DCF) analysis can be a powerful tool, but even small mistakes can lead to flawed conclusions. Whether you're valuing a business or assessing an investment, avoiding errors is crucial. Here are the most common pitfalls and how to avoid them. Overly optimistic projections. One of the most frequent mistakes in DCF analysis is inflating future cash flow estimates. While it's tempting to forecast strong growth to justify a higher valuation, this can backfire quickly. Overly optimistic projections often ignore risks like increased competition, market saturation, or unexpected expenses. For instance, assuming a startup will double its revenue every year might sound appealing, but it rarely aligns with reality. To avoid this, base your projections on actual data and be realistic. Use historical financial trends, industry benchmarks, and external factors to guide your assumptions. Ask yourself, is this growth rate reasonable given the company's size and market conditions? Being grounded in data results in more trustworthy valuations. Inaccurate discount rates. The discount rate is the anchor of a DCF analysis. Get it wrong, and your entire valuation could mislead you. Yet, many analysts either oversimplify this step or use generic rates without context. For example, using a low discount rate for a risky startup can make its future cash flows seem much more valuable than they truly are. On the other hand, setting the rate too high for a stable company may unfairly undervalue it. To avoid this, calculate the discount rate carefully. Use the weighted average cost of capital (WACC) when applicable, incorporating both the cost of equity and the cost of debt. For riskier companies or industries, adjust your rate to reflect the higher uncertainty. Always ensure the rate aligns with the reality of the investment's risk profile. Neglecting economic changes. Ignoring macroeconomic factors is another common oversight. DCF models often assume stable growth or conditions, but the real world is anything but predictable. Market downturns, inflation, interest rate changes, and global events can dramatically impact cash flows. For example, higher inflation can erode purchasing power, affecting customer spending and, in turn, revenue growth. Or consider recessions, which may disrupt entire industries and slash profitability. It's critical to factor in these potential changes. Stay updated on economic trends and adjust your forecasts accordingly. Instead of assuming static conditions, explore multiple scenarios, such as best case and worst case situations, for a broader perspective. This makes your model more resilient to uncertainty and gives you a more nuanced understanding of value. Practical applications of DCF analysis. Discounted cash flow, DCF, analysis isn't just numbers on a spreadsheet, it's a tool that guides real-world financial decisions. Investors, analysts, and business owners use it to uncover opportunities, weigh risks, and assess long-term value. Let's look at some key areas where DCF shapes decisions. Valuation of startups. Startups rely on DCF analysis, even with all the uncertainties tied to new businesses. Why? Because it forces founders and investors to focus on cash flow potential. Startups are often in their growth phase, burning cash while building revenue streams. In most cases, they don't have years of financial history to examine. Here's where DCF becomes useful. It allows you to project future cash flows based on assumptions like market size, customer acquisition, and revenue growth rates. These projections acknowledge the risks, but also highlight the value a startup could achieve in the future. For example, imagine a tech startup developing a subscription platform. It may have negative cash flow today, but DCF can estimate the future value if the platform scales successfully. Inputs like expected user growth, churn rates, and margins help anchor these projections in reality. Even though startup forecasts involve educated guesses, DCF ensures investors ask critical questions. If everything goes well, what's the long-term payoff? What discount rate reflects the risk of backing this venture? It's not about pinpoint accuracy, it's about making informed decisions amidst uncertainty. Project evaluation. When businesses decide on new projects, DCF often sits at the center of their analysis. Whether it's launching a product, opening a new location, or upgrading equipment, there's one question that matters: will this be worth the investment? DCF helps answer that by comparing the investment's cost with the present value of its future cash flows. This approach is widely used in capital budgeting, where companies must allocate limited resources to projects yielding the best returns. Take a renewable energy company considering a solar farm. The initial cost is significant, but the farm will provide value over its lifespan. Using DCF, the company can forecast cash inflows from energy production and government incentives. Subtract annual costs like maintenance and operations. Discount those cash flows to today's dollars. The result? A clear picture of whether the project's net present value, NPV, is positive or negative. Positive NPV? The project is likely worth pursuing. Negative? Time to reconsider or tweak the plan. DCF is critical because it accounts for the time value of money, ensuring long-term investments are judged fairly against short-term costs. Mergers and acquisitions. In mergers and acquisitions, M&A, the stakes are high. Companies involved need to determine if the price of an acquisition matches the value it can generate. Enter DCF. During M&A, buyers closely examine the target company's ability to generate future cash flows. DCF becomes a vital tool for estimating the intrinsic value, allowing them to avoid overpaying or missing hidden gems. Picture a large automaker acquiring an electric vehicle startup. Buyers will use DCF to project cash flow growth as the startup scales, factoring in uncertain variables like battery costs and consumer adoption. The discount rate will reflect risks tied to the startup's unproven nature while considering synergies post-acquisition. On the flip side, DCF also helps sellers defend their valuation. By demonstrating how projected cash flows justify the asking price, sellers strengthen their position during negotiations. At its core, DCF brings transparency to M&A transactions. It ensures decisions are guided by logic and evidence, not emotions or market hype. When billions are at stake, precision matters. DCF analysis is more than a theoretical concept, it's applied daily in arenas where financial clarity is everything. Whether you're funding a startup, evaluating a project, or negotiating a merger, DCF helps answer the big question: is this worth it? Each use case may tweak the approach, but the goal remains the same: uncovering value. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.